Hi everyone, welcome to this live TV. As usual, I will share with you my views on the market, fundamental and technical. There's a lot to take care of this week, so let's start with the calendar. We have pretty interesting data coming out today, and I would like to make a few comments about it. I will focus particularly in UK inflation. I was taking a look at this whopping 20.5% in input prices at wholesale levels, right? It didn't reach the consumer yet because, as you see, inflation rose by a little less than expected in January, still rising steadily and firmly. But at some point, this 20.5, okay, will probably affect inflation and send it way past the 2% comfortable Bank of England target, right? Um, I know it's colored green. The 7% is also colored green. This is house prices. But guys, anything above 10% is as bad as this minus 0.5%. Too high inflation is as harmful as deflation for the European economies. Keep in mind that the UK was in deflation, I don't know, 1 year, a year and a half ago, and all of a sudden we are having these wild readings. I would say that anything above 5%, in fact, is harmful, right, for the economy, and particularly if inflation rises at this pace, right, from a 15.8% revisit to 17, now we are 20. How long will it take until the inflation skyrockets in the UK? And well, markets speculating that the Bank of England could move rates in that case, right? But how much, when, and for how long are they willing to do something to take inflation down? We don't know. The latest Bank of England meeting, Governor Carney said that they will probably stay on hold, right? He didn't say it in fact, but hinted that it will probably remain on hold this year. So that they are tolerant with higher inflation. About how much tolerant is something we're going to see in the upcoming month if the pace of inflation remains this one. So beware of that. And another thing that it's a bit surprising for me today is the fact that this user by coming from Germany Joe, a strong setback in sentiment in the country, right, for this February. Um, I don't believe that this has nothing to do. It's even negative for the euro area, right? But the survey is German based. Anyway, I was saying that I believe that this negative sentiment has nothing to do with economic readings or economic figures. It has more to do with the political uncertainty the euro area is living with French elections, German elections, a probable referendum in Italy, Greece unable to seal a deal again. Once again, Greece struggling for bailouts with the IMF and the rest of the euro area. So all that kind of political uncertainty that jeopardizes the continuity of the euro area as it is, right? It's what's weighing on sentiment. So beware of that because that is somehow telling us that despite macroeconomic figures could be encouraging, right? The euro it's in trouble anyway, could be in trouble anyway. Anyway, and talking about macroeconomic figures, we had today GDP in Germany, GDP in euro area, both showing growth below expected, right? So, and pretty tepid growth in the region, right, for the last quarter of 2016, while we saw strong growth, I don't know, in UK, not so strong in the US, but still 2 point something percent. So uh, somehow today data in the euro area, it's telling me that the euro could fall back towards its recent record lows, 340 or something that it posted in January, right? Be aware of that. Anyway, the market is a little quiet today because we are waiting for Ms. Chalene testimony. Okay, it's a semi-annual testimony before the Congress, right? We are always looking for clues about when and for how much, and how many rate hikes we're going to get this year or the next, right? I do believe that Yellen has learned her lesson, uh, talking a bit of much more than she should in her first testimony a couple of years ago. So actually, and with the ongoing uncertainty also in the United States regarding Trump's policies, actually, I don't expect any big clues being given out today, right? I do believe that Yellen will remain modestly hawkish, sort of speaking, confident in the economy, confident in the recovery, but given no certain clues about rate hikes, how many, how much, or when, right? Um, on Wednesday, I believe that attention would center in the UK employment data, right? Today, inflation data in the UK was nothing but encouraging. And if these numbers are also disappointing for the market, the pound could resume its bearish trend and fell below 123. That's the level I'm watching, 23, 23.30, as the line in the sand for the ongoing upward tone, right? And the next big uh, reading will be in the US retail sales, consumer prices. I believe this too will have to be balanced, right? Either both reports positives or both reports negative to trigger some directional momentum in the dollar across the board. If we have one very good, the other very bad, or something mixed like that, we are not going to see a clear market reaction, right? Um, Another thing that's worth mentioning, we are going to go back to it, is that after Trump last week said that he's about to announce a phenomenal tax reform, right? Stocks resumed the Trump trade, right? Let's buy US assets in the hopes that his policies will boost growth and inflation, right? And we have stocks skyrocketing, yields recovering from 3-week lows. We're back towards the highs, not yet there, but going in the way. But the reaction is quite limited in the Forex market, right? It's like dollar demand, as speculative demand has stalled. I'm not pretty sure why that's going on, but if we have positive figures here, retail sales and CPI, well, that will probably be the what the market needs to rebuy the greenback, right? It's a possibility. On Thursday, employment in Australia, I believe, will be the most relevant news. We have data coming from China, really strong data coming from China lately, uh, rising imports, so healthy trade balance, right? And today, earlier in the past Asian session, we have really high inflation numbers. Uh, all of these figures coming from China are boosting the OC. We're going to talk about it. It's a key resistance area. But anyway, if this data is good enough, we can see the OC moving up towards 78.30, which is last year highs, right? So beware of that. Beware. I'm not sure if gains could be sustainable. And as I said a couple of times before, I do believe that the Reserve Bank of Australia will become to Jobo and be worried about the OC being so expensive, sort of, for them. So beware of any bullish movement. But the fact is that the OC is one of the strongest these days against the greenback, right? And for Friday, retail sales in the UK will be the first reading to take care of. It's expected a bit better than the previous month, but nothing really outstanding. So if the data is quite positive, the market will run to say, oh, resilient to UK data, resilient to Brexit, and buy the pound back, right? But if it's negative, well, then I would expect some further pound slides, okay? Anyway, let me flip to charts. 1 second. Here we go. Okay, here's what we are having in the market today. As you can see, the dollar is generally lower across the board, except against the pound, of course, because of what we just commented about inflation. Not much action going on in commodities. The fact is that they have entered a consolidative phase late last week. while stocks, after reaching record highs, right, are also in wait and see mode. I do believe that because of Yuan later today. Um, this is, yes, the German index. I take a look at it to take a look at how things are doing in Europe. But what we are seeing there is also strong wait and see stance, right? Anyway, let's go pair by pair, right? Starting with a friend euro. Uh, I was following this Fibonacci retracement, and as you can see, the pair corrected the 50% of that rally, that slump we have post US election with that spike up to 113 and the low around 30. We have correct up to the 50%, and the pair has broken back below the 38.2% retracement of the same rally, right? Now holding there. And take a look at the daily. It has been briefly above a bearish 100 simple moving average, but it's back below it. The 20 simple moving average is also gaining downward strength. I like these cases, right? When the shortest is closer to the price, and then we have the next and the next, and the price below this three, that's clear bearish sign, right? But also I would like to see this 20 moving average moving back below the 100, and the three of them having bearish slopes, right, and capping the price. That would be a clear sign that the US selling pressure, right? But well, we have to wait to see that. Anyway, the key support I'm following these days is that 565 level. It has been quite strong in the past as resistance. The pair had a strong battle and a consolidative phase around it, and able to clearly break it until it finally did and move up to 820. So my take is that below this level, we get a technical confirmation of a bearish extension, right? In the short term, what I'm watching is that the 20 simple moving average, right? The short term has crossed below the 1 and the 200 ones, and it's currently acting as dynamic resistance ever since late last week, all right? And so pretty much I'm seeing limited upward potential, right? What I'm waiting for, of course, is data, because central bankers, and I mean the land today, have the ability to pass right beyond technical readings. They can trigger moves that can break the market and trigger U-turns across the world, despite whatever you're reading in your charts. Anyway, yesterday high around 660. It's my immediate resistance. I believe that above that level, we have chances to retest the 700, 720 area. We have that spike up to 718. So I'm looking for a break above that level to deny the ongoing negative tone, right? Above 720, I could expect the pair to steadily go back to the 800, 840 region. That anyway, I suspect strong selling interest waiting there. So I'm not seeing a clear break beyond it. And on the other hand, if we lost that 565, I told you, the pair will probably return to the 500 area with not much in the way. And below that level, 460, 450 is my next bearish target and support, right? When it comes to the pound, right, as I said, we are in sort of a consolidative stage. I'm taking a look at this moving average, 200 exponential, 20 simple, both flat, both horizontal, going nowhere. What I'm also taking notice of is the fact that this 25, 30, 40 region is acting as a strong resistance. And sort of we have a line of selling interest there, right? And buyers, on the other hand, align around 24.30, 24.50. So it's a matter of which one gives up first, right? Either sellers in this area or buyers around this Fibonacci support. Given dollar strength and the recent uptick, whopping uptick in inflation, wholesale inflation, I believe that the scale is leaning towards downside, right? That we will break lower. Of course, we have Yuan in the way. But anyway, if we lost that 24.20 to 50 region, I would expect the pair to quickly fall back, to towards this low 23.46, yes, which also is the 50% retracement of the rally that starts right before Theresa May, right, unveiled her Brexit plan and said that the, they're going for a hard Brexit, right? Anyway, that's the level I'm watching. And if somehow the pair loses this one, there's nothing in the way pretty much until 22.15. We have the next figure and multiple intraday highs and lows. If somehow the pair manages to break above these highs, we can expect an upward move up to 26. But honestly, I'm not seeing much more beyond this level. I do believe that if the pair manages to move beyond that 26, we will probably see some interesting capping the upside and sending it back lower. And when it comes to the OC, well, here we are pressuring 77. Let me share with you my weekly chart. Okay, sorry for that. And draw a line around 77. Okay, there we are. Here we are. Ever since the pair broke below 77, right, mid 2015, right, attempts to rally beyond the level had been unsustainable, right? We have that spike in April last year up to 78.30, but that was the most. So I believe that this is a huge, huge barrier for the pair. Take a look at the daily chart also, right? And let me zoom out a bit. Okay, attempts to regain that level have resulted in sharp bearish corrective movements, right? So take a look ever since April last year, right? So we are at a critical level. And to be honest, despite I'm seeing the pair modestly bullish, I'm not willing to buy at these levels, right? I would rather prefer to take a step aside and wait for clearer definitions whether the pair can rally past 78, to be honest, at this point, to think an upward extension up to 80. Probably because of market momentum and regardless the Reserve Bank of Australia, and or wait to sell in between 77.50 and that 78 region, right? If the pair is unable to break above 78. So I believe that this is a very critical area and it won't be easily taken. So beware of that. In the short term, and as I was saying, the pair is bullish, to be honest, if we have to believe in our indicators, right? Above a 20 simple moving average with indicators heading north. And what I'm also watching is that around 76, right? We have the base of the range and the line of buyers. So pretty difficult this one to trade for me, at least at the moment, right? I do believe that buying at this area is still risky, but I don't see a selling opportunity unless we move towards 78 and start retreating, okay? Let me go towards dollar Japanese yen. We have that spike this week up to 14.16, I believe, right? Early Monday because of poor GDP figures and Wall Street running to record heights on the so-called Trump trade. But here we are, the pair was unable to hold gains beyond 14. And it's, again, pressuring the 13 figure. This is telling me that the bearish trend remains pretty alive, right? There's not much in here. It's telling me that the pair could regain the upside. If we move to intraday charts, the price is trading between its 200 and in 100 simple moving average. It's true the short term is offering some support, right? But take a look, they are both heading south and indicators are also heading lower. So, and despite what the rally we are seeing in stocks, in stocks this last 3 or 4 days. So if the pair was unable to rally with that, I don't know what can push it higher, right? A surprise rate hike in the US, that will be the only real trigger that can push the pair through 14.16, 14.15, which is for me the level to beat, to talk about some upward constructive trending here. Okay, so beware of that. Beware of that because it's going against against the usual, and the risk is for me towards downside. Below 13, I could expect the pair to go towards 1260, 1250, and below that level retest this area 1190, the 38.2% retracement of the latest bullish run, and a level that it won't be easily broken again unless we have really bad news coming from the US. But I'm still not seeing any upward opportunity here, despite whatever we are seeing in the rest of the market. Okay, beware because it's quite bearish in here. Oil prices have made no progress. The chart is quite boring with the price moving back and forth around this flat 20 simple moving average. Take a look at the momentum indicator since December. We are seeing nothing in here. And I do believe that this range will persist, and that the risk, despite whatever price action is slowly turning towards downside, because despite the OPEC compliance with its output cut, we are seeing US production rising way too fast. Way too many oil rigs drilling oil, way too much stockpiles. Last week, reading the AP, the AP reading was the second largest in the records. The EIA announced over 12 million barrels added. It's crazy. So this US production is offsetting whatever effort the OPEC is doing, and therefore there we have range, right? If the OPEC doubts a bit about its output cut, then we will probably see the commodity breaking below 50. But so far, trading 54.50, 51, sorry, 51, 54 range. It's the way to play oil. And I'm more willing to sell near the top than to buy near the bottom because, as I said, I do believe that the risk is towards downside. And for gold prices, well, I still will see a modest bullish potential in here, particularly because in the daily chart, we have the 20 simple moving average acting as dynamic support after crossing above the 100. But the commodity is struggling around this 50% and unable to find direction. Today, it's all about the Fed, right? Gold, it has been all about the Fed for the past 2 years, with the commodity trading in correlation with Fed zone. Hawkish Fed sends it lower, a dovish Fed sends it higher, right? So beware of whatever Yellen had to say today, and we will probably see some upward potential in the short term. 1235, 1237 is the immediate resistance area ahead of this highs around 44. In fact, I have a static resistance around 45.20 long way ago, a strong level to follow. So I would like to see it breaking through 45.20, okay, to think about an upward extension here towards 1300, right? And on the other hand, we have a mess of support levels to the downside, 1222, 1214, right? This 1415 and 1200. We have this FIBO around 1204, but 1200 seems stronger, right? We have some spikes below that level, but we're quickly reverted. So 1200 is the key, because below it, the commodity will probably finally gave up and resume a downward move, particularly, of course, if the Fed, its hawkish, provides a rate hike or announces more rate hikes in their way, okay? Anyway, that's it for today, guys. Thanks for being here. Thanks for sharing your time with me, and see you back soon, okay? Thank you, and goodbye.